Hey, it's Dave Chilton, the Wealthy Barber and former Dragon on Dragon's Den. Welcome to the Wealthy Barber Podcast, where we'll be hosting some of the top minds in the world of personal finance. Yes, that's to balance me out. The podcast is about making the subject not just easy to understand, but dare I say, even fun, honest. Whether you're trying to fund your retirement, figure out how to build a down payment, save for your kids' education, manage debts, whatever, we'll be here to help you do it. Before we jump in, a quick but important note: nothing we discuss here should be taken as investment advice. We don't know you and your personal financial situation, so we're not here to tell you where specifically to put your investment dollars. We're here to educate, get you thinking, and we hope entertain. But please do your own research and/or consult with your financial advisor before taking any action. Hey, it's Dave Chilton, the Wealthy Barber, Wealthy Barber Podcast, episode number 24. Thrilled with all the feedback from you listeners. Thank you very much for the comments and ratings. Today we have, I'm going to sound a little dramatic, a true superstar from the world of Canadian personal finance, and I mean that quite sincerely. Jamie Golombek, he's been around for a long time and helped a lot of people. What nicer compliment can you pay to somebody than to say that? You know, he's given great instruction, great education over the years, helped people with their taxes. He's currently Managing Director of Tax and Estate Planning at CIBC, a private wealth. He's done a lot of other things in his career. He's a CPA. That's an important thing to bring across. We don't just pull these people off the street. This guy has the proper educational background. In fact, in 2023, he was named a CPA Fellow of Ontario. I think I've got that right. But the key thing there is that is the most prestigious designation you can get in the field. It speaks to not just his ability to communicate and his knowledge level, but his sense of leadership, community, etc. He writes tax expert column for the National Post. You've seen him on TV a lot, BNN, CBC. He does a lot of speaking where he's excellent. He and I met way back in the early 2000s giving speeches. I also used to see him at the airport all the time, walking through or getting on a flight. Very well-respected guy, and I think you're really going to get a lot out of today's podcast. Now, that is immense pressure, Jamie. Do not fold. Do not let us down after that build-up.
Good to see you. Very kind, David. Thanks so much for having me. You know, when I first saw your email come across my desk a couple of weeks ago, I thought, oh my gosh, wow, I would love to be on that podcast. And I don't do a lot of podcasts, right? So most of the stuff we do is in-house stuff.
Right.
We rarely do third-party stuff other than sort of accredited news organizations. So this is an unusual thing. But I said, look, David Chilton, when the Wealthy Barber calls, we answer because I'm probably one of your biggest fans.
Thank you.
Over 30 years, we can chat about that later. But, I still bring it up all the time when, when kids ask me, what's the best thing to read? What's the best book I can read? They want tax textbook. I said, don't read anything. Just read the original Wealthy Barber. Lots of copies around in the used bookstores for $1. I don't know if you get any revenue off that one. Sorry, Dave. But
that's fine.
Lots of copies lying around. Easy to get one. And we can talk more about that later. But big fan of yours as well.
Thank you. We have an updated version, fully revised and updated, coming out in a few months. It's been a year putting it together. Tougher now, of course, because, when I wrote the book, there was just RRSPs. Now, of course, there's TFSAs and FHSAs and all of the new complexities, plus the housing costs obviously make a lot of this challenging for different levels of income. So it's tricky. When we talk about tax planning and estate planning, we'll touch on both, but you've got the big umbrella of financial planning. And for whatever reason, a lot of people equate that almost with just investing. But there's so much more to it than that. There's cash flow management, there's estate planning, there's tax planning. Tell us in your mind, what are the definitions of tax planning and estate planning?
Yeah, so I think, look, tax planning looks at the amount of money you're giving away, or at least paying each year to the government, all levels of government. And are there things that you could be doing both in the current year, but also over a long period of time to reduce the amount of tax you pay? It's that simple, in a legal way, in a way that will never get you into trouble, that you won't read about yourself in the newspaper, and something that you'd be proud to show your tax return to the CRA. And this is when I talk about tax planning, I have no shame or I'm not nervous at all, because anything that I do, and I got about 20, 30 ideas that we could talk about, each one of them I'd be proud to show to the CRA and say, here are the 30 things I'm doing to pay less tax. Please audit me. Because I have been audited. I've written about it many times in the newspaper, and I've won every single time. In other words, as long as you follow the rules, there are many opportunities, just basic stuff that people are missing. So that's tax planning. Estate planning is the goal, again, to make sure that your estate is transitioned to whoever you want. That could be your spouse, it could be kids, it could be charity,
Right.
in an efficient manner and the way that you want them to be transferred, as opposed to the government. Because, as you know, you don't have a will, the government has a set of rules called the intestacy rules, which actually specify what happens to your money. And people often think, well, if I die without a will, my spouse gets all my money. That is
No.
actually not what happens. Like, for example, in Ontario, where I live, you die without a will, the spouse only gets a preferential share. The rest of that is divided up between spouse and the kids, and you have no say whatsoever about the money going to the kids. So, in other words, if you want any say at all over what happens to your stuff after you die, you want to have an estate plan, which includes things like wills, powers of attorney, life insurance, probate planning, some tax planning, and just, organization documents, things like that. Trusts even, it can get more complicated.
I love your example because I think in Ontario, if I'm not mistaken, the first $350,000 goes to the spouse, and then it's divided 1/3 spouse, 2/3 kids.
You got it.
And the vast majority of people have no clue that's the way it plays out. They think that the court's going to use judgment based on the needs of the beneficiaries, et cetera. This is rigid stuff. The odds of it matching up to your wishes are literally 1 in 100.
And just to add to that, David, one of the things I often give, and, you and I have crossed the country together on presentations, and I have a estate planning presentation I've been doing for 25 years. It's almost exactly the same in 25 years, other than updating that 350. It used to be 200.
Right, that's right.
It's mostly the same. But one of the examples I always give is that once your kids are 18, at least in the province of Ontario, they're legal adults, which means that if you die without a will, and 2/3 of that rest of that money goes to the kids, they're 18 years old, and they're in grade 12 in Ontario. They get the whole thing on the day they turn 18, and the surviving spouse has no say whatsoever about the money going to the kids. The kids can do whatever they want with that money. I tell stories at seminars about horror stories that we've heard over the last 30 years about kids who receive large amounts, like $50,000, which is a lot of money for someone in grade 12. And they just drop out of high school.
Right.
And they buy themselves a car, and they go on a road trip, and then the money's gone, and it's a real tragedy. So, if you want any say whatsoever, even if your estate is $50,000, forget $50 million, $50,000, you want to have an estate plan, and an important part of that, of course, is a will.
Jamie, it's even worse for me. I was only in grade 9 when I was 18. So I struggle. I struggled. That example is an excellent one. And again, you've got to get a will, and they're not that expensive. If you go to a lawyer, most times a straightforward will is $400 or $500, often a loss leader for the lawyer. We now have willful and epilogue and online sets of rules and ways you can do it. That's very inexpensive, as low as $100 in some instances. So, and we'll talk more later about powers of attorney, because I see that area blowing so much, and the fallout is scary.
Yeah.
The negative impact on families is crazy. Let's go back to tax planning for a second, though, and I'll ask you the most obvious question, the one you've been asked most frequently in your career. What are 2, 3, 4 mistakes that you see most often from the average Canadian?
Well, the easy one that I talk about more than anything is, getting excited about your big tax refund. I'm not talking about getting a few $100s back. I couldn't care less. Right. If you're getting back thousands of dollars every single April or May, there's something dramatically wrong with your entire plan, right?
I agree.
And that means that you're basically overpaying your taxes throughout the entire year. Now,
year after year.
Yeah. Every year, right? So what happens is, the reason why most people get a large, I'm talking about the thousands of dollars, sometimes we've seen in the tens of thousands of dollars, is that they have deductions in most cases, sometimes credits as well, that their employer simply doesn't know about.
Right.
In other words, if you're an employee, as most people are, you could be self-employed, in which case you can reduce installments and things like that. But most people who get big refunds are employees, because their employer is required to deduct statutorily under law. They are required to deduct the correct tax on your income. But they don't know about all your other deductions and credits, or at least most of them. And some of them they know about, the basic amount, spousal amount. You fill that in when you join the company. But most of the other stuff, like the juicy stuff, like the RRSP deductions, right?
That's right.
If someone's divorced, the spousal support payments could be, enormous, right? Deductible, right? You could have significant charitable donations. We've got clients that give tens of thousands of dollars a year to charity that gives rise to a massive tax refund every year, right? So if you've got all these various deductions and credits that your employer doesn't know about, then what you can do is you can apply using a one-page form to the CRA. You got to do this every year.
Right.
For a reduction of tax at source. So the time to do that, by the way, is November. So
because it's government. It takes them a long time to sort this out and get it back to you.
No, I'll tell you a quick funny story. I actually wrote about this in the newspaper, but I do this every year because I have a variety of deductions from RRSPs to donations, etc. And every year I get an approve. I've done this for over a decade, right? To get a pre-approval. And I usually do it at the end of the year. Sometimes it doesn't come in time, so that's fine. They prorate it for comes in February, whatever. So I thought I was going to get a head start, a couple years ago. So I sent it in August.
Oh, wow.
They sent me a letter in October saying they returned it to me, and they're saying, sorry, it's too early. We don't process this until November. Please resend it. Can you imagine?
Funny.
This is the CRA, right? Sort of filing it somewhere and anyway. So I sent it in November 1st, and I had it done in December, and it was ready for Jan 1st payroll. And what they're effectively doing is they're authorizing, because your employer can be fined severely for not withholding the right amount, right? So unless you get an approved letter, which is sent back to you, the taxpayer, authorizing your employer, you then send a copy. What I do is I scan it in to the CIBC HR department, and they know exactly what to do. They get lots of these. And within a few days, by the next payroll, they are able to reduce my income to take into effect all my deductions and credits. So in other words, instead of waiting till next April to get this big juicy refund, I'm actually getting it every 2 weeks.
As you go.
Increase cash, right? And then what I could do is take that extra cash and use it to do RSPs, TFSAs, RES,
Mexico.
Everything. Yeah, travel. Yeah, absolutely. So
now,
that's
two key
easiest
points you brought across there. One is that you have to request this from the CRA. A lot of Canadians think when they first do this, I go to my HR department first, but you don't. You go to the CRA, you file the form, you get it back, and then you have to take it into your payroll department or send it electronically. Yeah. But you made another key point earlier. A lot of people have slipped up on. You have to do this every year.
Every single year, unfortunately. There are some situations where, like, for example, if someone has a spousal support agreement that doesn't change, you can get 2 years approved at once, but that's the maximum.
Couldn't agree with you more that that's one of the big mistakes made. Where I see it really impact people negatively is on the RRSP front, is that they don't get that in, and it makes such a big difference in their cash flow going forward. And then, of course, the money's come back in from the government. What do they do with them? Do they put them into the RSP, et cetera? This is just such a cleaner way to go. One quick question on this. You're a member of a group RRSP at work. Does your employer know your contribution amount therefore and automatically adjust as opposed to you having to send a letter in?
Absolutely. That's the biggest advantage that we tell people of the group RSP. I mean, we can also go back to your book, right? Where the automatic savings, that's the first chapter or second chapter. I mean, that's the most important message from your entire book, I think, if not your entire career.
I agree.
Save 10%. Like I tell that all to everyone, right? It's to save 10%. But if the money comes off the top and it goes into an RSP, your employer by law can automatically and does automatically reduce your income and therefore reduce the amount of tax. So effectively, by doing a group RSP or an automatic payroll reduction, where your payroll goes directly into the RSP, your employer actually reduces your taxes. So you don't need to file the CRA. You don't need a fancy letter. It's just done automatically. And then again, you set it and forget it, as we often say, right? You set up that payroll every couple of weeks, automatically going into the RSP, and you're getting your refund every couple of weeks as well. So great idea.
Now, you truly are one of the sharpest guys in the personal finance field. I mean that sincerely. All these tricky ideas that we see out there, but I think you and I agree on this. The group RSP, when it has a matching provision, is the single best thing in personal finance. I love FHSAs too, but let's go to the dollar for dollar matching in a group RSP. You get the forced savings. The government aspect's taken care of, to your point. You don't even have to file the form, but you get 100% return on your money the second you put it in when it's dollar for dollar matching. This is the best thing going in Canada.
Yeah, like a lot of people forget about this. So at CIBC, we have a limited type of program like that. It's not necessarily on the RSP. It's a share purchase plan. Same argument, right? Fortunately, not everyone, but most employees do it. If you have a share purchase plan at work, whether it's an RSP plan or just a regular matching plan, and they're giving you free money
Free money.
Why would you not take advantage of it? And I tell people this all the time. Just save the minimum amount that you need to get the maximum match, right? Because not everyone will do the whole 30,000, whatever the maximum RSP limit is this year, right?
Yeah.
But there are limits, and depending on how big the organization is, the limits might be quite small because it costs a lot of money to do it for 50,000 employees, right? But I tell everyone in all of my presentations, I do a lot of speaking, of course, across Canada. A lot of that speaking is to our own employees here at CIBC. We have over 45,000 employees, right? And I always tell them, if you're not taking advantage of the share purchase plan, forget about RSPs and TFSAs and all this other crap that you're going to do. You're losing free money. This is free money. It's not free. You got to pay tax on it, but it's still free money that you otherwise wouldn't have. So I agree with you, David. I mean, that is absolutely, whether it's an RSP match or a share purchase program. Again, I've done calculations for people. I show them, I'm nervous about the stock. You know what? The stock can take a beating. You're getting free matching. You'd have to lose a fortune to be able to be worse off by not taking advantage of the matching, depending if it's a 50% or 100% match. So I don't buy the argument that, it's risky.
I'm with you totally. I spoke for a firm in Boston, a robotics firm, 20 years ago.
Yeah.
And the CEO said to me, Dave, we have a 401k, the equivalent of a group RSP down there, but we're matching right now based on a 3-year rolling average profit sharing. For every dollar you put in, we match with $4.95.
Wow.
$4. And he says, and I still have 25% of people not doing it. What do you think I should do? And I said, fire them.
Yeah.
If they're so dumb as to turn down $4.95 for one, they're not adding value in this company. Get them out of here. And he just laughed and he said, there's probably some truth to that.
I would say
no, that's crazy. Can you imagine putting $1, your 401k or your group RSP, and now you've got $5.95?
Yeah. You know what? When I talk to people who don't do it, they got a much bigger problem, like honestly, right?
Yes.
When I ask them why they don't do it, you know what the answer is? They need every dollar of their paycheck. And that's a big problem. And that goes back to your book.
I agree.
Again, I was reviewing it again this morning. I hadn't looked at it in many years, but live within your means. I mean, that's probably one of your biggest philosophies, right, from that book, right? The original book is that you got to live within your means. You got to have a budget. Don't buy the right size house, get the right rent, live within your means, have a budget. And that budget needs to include retirement savings. Or if you work for a company with a matching, your budget on top of food and clothing should include this free match, because you're never going to do better than free money from your company, right?
No, I absolutely agree. That being said, I'm very sympathetic to the fact that costs have gone crazy in Canada in the last X number of years. And for a lot of people in middle income and down, all of these speeches aside, it's very difficult to make the math work. I'm seeing a lot of spending summaries lately where people aren't wasting money.
Right.
And they're still having trouble making ends meet. So it's very, very difficult indeed. Okay, you mentioned earlier that you've got a number of tips you give to people, ideas that they can pursue that maybe can save them some tax dollars. Throw 2 or 3 of the better ones at us.
Yeah, look, the other one that I think of is making sure that our clients, that our investors are taking advantage of all the different registered plans. I think we've got about a half a dozen registered plans now. Depending on your needs, right? But I'll just tell you a quick story. Everyone wants the sexy new product, right? Or even the sexy old product. We had a client a number of months ago that wanted to book a private meeting with me, very high net worth individual, because he wanted to talk about immediate financing arrangement, leverage life insurance strategies. Right. I said, great, very sophisticated, very powerful product. We sat around the table. We spent 45 minutes, went through it. He loves it. He's going to put millions. Great idea, right? He says, Jamie, you got anything else for me? And I said, well, I got lots of ideas for you, but I assume you guys have done the basics, right? Done RSPs, done TFSAs. He goes, you know what, Jamie? I'll be honest with you. I actually don't believe in RSPs. Sorry, you don't believe in them? This is a high-income individual, high tax bracket for his whole career. You don't believe in RSPs. It's not like a religion. You don't believe in it. I can show you the math.
It's math.
I've six reports I've written on RSPs. I can guarantee you, hands down, you're better off with an RSP than non-RSP, even if you're always in the top bracket. People don't understand. If you're in Ontario, where we live, right, and you're in a top bracket, let's call it 50% to make it easy. If I have $10,000 of employment income, and I put that into my RSP, I have $10,000 invested for me for the rest of my life until I take the money out of my RIF or until I die, right? If I choose, I don't believe in RSPs, which means I'm just going to invest the money in the stock market, let's say instead. I take the $10,000, right away I lose half of it.
Now 5.
It's now 5. So I take that 5 and I invest it in the best strategic non-registered account, right? You still have only half the money working for you.
Yep.
So at the end of the day, even if you're in the same tax bracket, you're always going to be worse off with a non-registered account than an RSP. So again, there are scenarios where, if your time horizon's short and you're in a low bracket now, you're going to be a higher bracket, in 5 years' time when you take the money out. Yes, we have seen outlier scenarios, but certainly for high-income clients that we talk to, you're absolutely always better with the RSP. We've written many reports on this available on our website. We have myth busting with RSPs. So I'd say, look, maximize all your registered plans. So I would say RSPs are great for retirement. RSPs are also good to help with the down payment, although that's less important now with the other plans, the FHSAs.
Right.
Let's talk about TFSAs, tax-free savings account. Again, no age limit on that one, right? You can be any age. You don't have to be 71 or under like with an RSP, right? So TFSAs are really an all-purpose type of savings vehicle that can be used for anything, including a wedding reception. Like you can use your TFSA to buy a car, to fix your roof. So TFSA, great emergency fund, things like that. For children, if you got kids, there's any remote chance they're going to go to post-secondary school. It doesn't have to be some fancy university, right? It could be a vocational program, could be a trade school, anything, right? RESPs, again, free money, right? The government's going to give you 20% Canada Education Savings Grant on the first $2,500 a year. So you put in $2,500 per child, $2,500 per year per child with a 20% match. That's a $500. I mean, it's a great deal. 20% guaranteed rate of return every year. No bank will guarantee you that, right? 20%, right? So RESPs is a no-brainer. And by the way, if the kids don't go to school, you can get all your money back. Like your contributions can always come back to you, right? So, RESPs are a slam dunk. If you have someone in the family with a disability, people forget we have a registered disability savings plan, which allows you to set up to $200,000 aside for any individual that qualifies for a disability tax credit. And again, if they're under the age of 50, you can get, $70,000 of disability grants and $20,000 of disability bonds deposited directly into the account.
And you know what's interesting is I've done a poor job on this, to be honest, educating around DSPs. I've not given it enough attention. One of the things I've done lately dealing with people is I just use the $90,000 figure. That gets their attention.
Absolutely.
I mean, I should have done that years ago, to be honest, because they go, wow, that's a crazy amount of money. We need everybody. The government needs to do a better job in that front. All of us do. But you're right, all these accounts, and you haven't even mentioned the FHSA yet, which I would argue in many ways is the best of the bunch.
It's the best of them, right? So the way I explain the FHSA, it's got the best of the RSP and the best of the TFSA. See, with RSP, let's go back to basics. Like with RSPs, you get a tax deduction on the way in, but you got to pay tax on the way out. With a TFSA, you're using after-tax dollars, so you don't get a tax deduction on the way in, but at the end of the day, it's actually free on the way out. So mathematically, RSPs or TFSAs are actually, they're mathematically equivalent if your tax rate is the same today as the same as in retirement, right? FHSAs are better than both because with an FHSA, you get a tax deduction for the $8,000 that you put in to save for a first home, up to $40,000 over 5 years, right? 8,000 times 5 is $40,000. But when you buy that home anytime within 15 years, the entire amount comes out tax-free. Not just $8,000 a year, but all the income and growth comes out tax-free. And you know what, Dave? There's no downside.
No.
You don't buy a home within 15 years, guess what? The entire amount can go into your RSP. You don't even have to have any RSP room. Like, it's a great deal. Anyone who doesn't own a first home, in other words, no home in the current year or in the previous 4 calendar years, should start with the FHSA. Tax deduction on the way in, no tax on the way out, and no tax for 15 years. So I think we went through 5 or 6 registered plans. And, before you start talking to me about leverage universal life insurance strategies, let's just make sure that you've done all the basics. And let's go back to your book. Pay down your credit card.
I couldn't agree with you more. Yeah. No, I mean, you and I see this exactly the same. I mean, I always say the FHSA is the perfect love child of the RSP and the TFSA.
You got it.
It's like they made love and came up with this, and it's the best of all worlds. And it's amazing to me, up until about a year ago, how few people knew about it. Now, we have had a big pickup on the education front, and people were taking advantage of it more. You alluded to something earlier that's been probably my biggest source of frustration the last few years, and that's how many in the public and even some in the industry have incorrectly turned on RRSPs. There's so much misinformation out there. Mark McGrath of PWL, he's retired recently, but he did a great job of bringing this to the forefront. And you said it eloquently. This isn't a religion you believe in or don't believe it. It's math. And so you and I look at all the math and we look at all the numbers. RRSPs are still phenomenal. Are they always better than a TFSA? No. They're not always better if you can only do one, which of course many people find themselves in that spot. But they're a very solid investment return. They're a very solid container for your investments because of the tax advantages. What happened that all of a sudden, I think it's baby boomers taking out the money and having to pay tax on it. They've lost sight of the basic underlying math.
They did, and I think that's exactly you're bang on. That's why we wrote a whole report called "Refuting the Myths of the whole RSP strategy." Is because the problem is that people say, "Oh, when I take the money out, it's just fully income," and they've done better in their life than they ever thought they would be. So they're now in a high tax bracket. They're losing their OAS, which we could talk about that for hours. People are angry that they have so much wealth that they've lost their free OAS. And don't get me started on that one, right? But good for you if you've lost your OAS. That's what I say. But in any event, people have so much money in retirement. They're in a 49, 50%, even 53% tax bracket, and they're angry because now they're 72. And they have to take out, let's say, 5% in the first year, right? And they've got an RSP that's worth $1 million or $1.5 million or whatever. Yep. And they're taking this money out and they're losing half of it. And they said, I would have been better off had I invested in a non-registered account because then I don't have to force to take the money out. And it's capital gains. And capital gains are only 50% taxable. You're wrong. You're just wrong. Just look at the math. We wrote a report 15 years ago when I joined CIBC, one of my first reports that I wrote called Just Do It. Nothing to do with Nike. We didn't get permission. Different industry. But it was called Just Do It. It's the case for tax-free investing. Yep. RSPs give you a tax-free rate of return on
your part of the contribution.
On your part of the contribution. And
that's exactly what I've been saying on stage.
We have 4 charts. Just Google it. Just Do It. Golombek, CIBC, 5 pages. And if you read that, you still disagree with me, send me an email.
You'll love the Wealthy Barber redo because it talks about this at length and how off people have gotten and all this. I want to leave this, but I do want to touch on something that I'm very passionate about in this argument about RRSPs. There's been a misconception again out in even the industry that everything you take out of your RRSP is taxable at your highest marginal bracket. That's not the case. Oftentimes you'll have somebody take out $50,000 in a year, $70,000 in a year. It's not all taxable at the highest marginal rate. You have to look at the average rate on that money, the average tax rate, and compare it to when you first contributed. Even when you're doing the versus TFSA calculation, I cannot believe how many people get that wrong, including smart people. There's just been this whole thing. Yes, it's all coming out in the highest marginal rate. It's not.
Yeah, only if you are one of those, I'd say 2% of taxpayers that are already in the top bracket.
That's right.
Well, all of them come out at the top rate, right? And that's a very few people, right? It's in the hundreds of thousands of people in Canada, not in the millions, right? So very few people will have all of their income at the highest marginal rate. So what you have to do, and this is why we promote, using tax calculators. There's a lot of free tax calculators on the websites available. Right. I mean, for example, the one I used it 3 times this morning already, working on a client file. Ernst & Young. Again, we have no connection. I'm not promoting them specifically, but they have an Ernst & Young online Canadian tax calculator for 2025, 2024. For every province, it's accurate to the dollar. I've checked it against the tax software, right? And when I need a rough calculation, someone's making, 40,000, 80,000, 150,000. I just type it in 1 second. I will get their tax, their marginal rates, their average rates for every province in Canada all at once. So again, I use this multiple times a day. It's free, it's easy. And then we've also produced at CIBC a tax toolkit that actually it's 24 pages. It's available for free on our website. And what it does, it actually shows you the marginal tax rates for every single dollar of income in every single province. So if you take Ontario, 0 to 10, 10 to 20, 20 to 30, all the way up to the bracket, of 250,000 and all the different types of income, right? Because not all income is taxed the same. And we haven't talked about this yet.
Absolutely.
Employment income and business income and interest income is fully taxable, whatever your, marginal rate is. But if you get Canadian dividends, you get a dividend tax credit. The maximum rate you would pay in Ontario is only 39%. Even if you make $10 million a year, it's 39%. And capital gains, we already touched on briefly, Capital gains, thank goodness, are still only taxed at a 50%, supposed to go to 2/3, didn't happen, 50% inclusion rate, which means that even if you're in the top bracket in a province of 53 or 54%,
27%,
right?
yeah.
26, 27%, that's the maximum rate. So when we look at clients' investment portfolios and we want to have a knowledgeable chat with them about taxes, we say, hey, wait a minute, can we be more tax efficient in the structuring of your portfolio? Are we paying, high taxes on interest income, bonds, GICs? Should we move some of it, taking into account the risk return profile, of course, as you're aware of, but can we move some of it into equities, particularly Canadian equities, where we get Canadian dividends like bank stocks, high dividend paying stocks, right, that are very tax efficient.
Right.
And then do we look at things that earn capital gains that we don't realize every single year? We don't sell our bank stocks every year.
Of course
we
not.
sell them in 5 years or 10 years when we rebalance. Then we're not only are we getting a capital gains return, which is only half taxable, but we're getting that deferral, the ability to defer that tax to a later year. And as we've often said, tax deferred is tax safe, right? Because you don't pay it now, you pay it in 5-10 years. You have the time value of that money continuing to appreciate on a pre-tax basis.
Yeah, no, all that's true. Now, again, that's in non-registered accounts inside the TFSA and RSP.
That's right.
Not quite the case. No, that's interesting. You brought up something earlier that doesn't get much attention in Canada. Huge advantages to being married later in life on the tax front. I mean, it's actually a very big difference between what an equal family income of two people, married people, relative to a single person. Do you think that's fair? What can be done about that? Should we be doing anything about that, or is that just what it is?
Yeah, well, it is what it is right now. There is a movement to change that. I just wrote about this in a column a couple of weeks ago, right? I wrote an article on progressivity in the Canadian tax system. And one of the issues that we have here in Canada is that, we file individual tax returns. We don't have a family tax return. And that's very different in the U.S., right? The U.S.,
it is.
Most couples, not everyone, but most couples file joint tax returns, and they've got, combined, income brackets. And one of the recommendations based on this article I wrote in terms of tax reform is the government reopen this and see if that's something that they would consider, whether allowing couples to file, together a joint return. Because you're right, there really is a big difference. And of course, the bigger issue, as I'm sure you know, is that our rates are so steeply progressive that our high rate kicks in way too soon. And we have our highest rates kicking in at $250,000 or so federally, right? And, if you compare that to the U.S., their top rate kicks in at multiple times higher.
And in most places in the world, it kicks in at a higher level.
We're an outlier there for sure. So that's part of reform. And, there's arguments about the family unit, and do we tax as a family unit? And therefore, is that a disincentive for some, part of the population not to work? And I think they've been able to refute that in many cases as well. So a lot of work to be done there. It would be part of a very comprehensive tax reform. I don't see it happening in the near term, and maybe not with this current government. But maybe it's something to look forward to in the future. But you're right. There certainly are significant differences if you have $100,000 of income earned by one person or $100,000 earned by two people at $50,000 each. Obviously,
huge
graduated rates and the fact that they each get a basic credit, although you could share that anyway. Really, it's the graduated rates, the amount of taxes. It's in the thousands of dollars, right, of difference.
No, when you start breaking it down, it's hundreds a month relative to mortgages. I mean, it's a huge difference maker, no question. You've talked a lot in the past. In fact, I think you've done the best job of anybody out there about the merits of using shares in companies to contribute to charities. Can you just walk us through that? I actually think that got more attention years ago than it gets now. It got lost in the shuffle. You're the guy who actually keeps it alive a little bit and brings it up. Walk us through why that makes so much sense.
It comes up every day. I already had a client meeting on it this morning. This morning at 11:30 this morning, Eastern time, we did a call. And at the end of that call, one of the issues was the strategy. Strategy is simple. It's been around for over a decade. If you're going to make a charity, you never make money, by the way, by giving to charity. And if you do, you should be worried.
You should be ashamed. You should be ashamed.
Be assessed in those tax shelter deals. So if you're making money by giving to charity, there's a problem, okay? Right. But generally speaking, if you're charitably inclined, philanthropically inclined, right, you're going to give to charity anyway. The best way to give to charity is to give appreciated securities if you have them in a non-registered account.
Non-registered account.
So think shares of Apple, shares of NVIDIA, mutual funds, segregated funds, anything that's gone up in value. because when you give those shares directly to a registered charity, or in some cases to a foundation, that could be a donor-advised fund that's run by many of the banks have them, or maybe the public foundations have that as well, city foundations, community foundations. But when you give these appreciated shares to charity, not only do you get a donation receipt for the fair market value of that donation, which depending on the province, it's worth, up to 50%, right?
Right.
But in addition to that, you pay no capital gains tax.
That's the key.
So imagine you bought Shopify, a year ago or so, and now you've got 4 times your money, right? You give that to charity, the entire gain is tax-free. So you get a receipt worth 50%, and you save 26% potentially, depending on your tax bracket, of capital gains tax. So this is the number one way people have appreciated securities outside of an RSP or a TWB, right? You have to have them in a non-registered account, should be giving to charity. It's amazing. And I work with one of the very major charities here in, I don't want to get too specific, but here in the Greater Toronto area. And this is a charity that receives, hundreds of millions of dollars a year of charitable donations. And I once asked them to run the stats for me. I said, give me a list of, not the names, because they wouldn't tell me, but even though I'm involved with the charity, I said, send me a list of how many people, give over $10,000 a year, every year. Because I figure these are wealthy people. Like if you're giving $10,000 a year to the same charity, you probably have some kind of wealth. You probably have a portfolio of some kind. And they said, okay, we've got this many people. I said, well, what percentage of those gave a gift in kind of shares or securities in the last year? You know what that percentage was?
Very low, I bet. 5.
Want to guess? 9%. 9%. Okay. And I was shocked. And I said, here's what I would do. I mean, I'm not going to tell you what to do because I'm not on the board. But if you get a check for $10,000 or more, don't cash it. And they look at me
go back to them.
Go back to them and say, do you realize that instead of giving me this $10,000 check, I'll work with your financial, people think it's complicated. I do it every year. It takes 5 minutes, by the way. 5 minutes. Right. That's how much it takes me to donate my shares to a registered charity. So you work with a charity that knows what they're doing, like a big major, either a foundation or a donor advised fund or, whatever. And in 5 minutes, you transfer $10,000 worth of shares over, if that's the size of your donation. And right away, you've saved 26% capital gains tax. It's so easy to do. I've been doing it every single year, year after year. What I do personally, David, is actually use a donor advised fund. So as part of a public foundation, I use a donor advised fund. And every year I go to my advisor. I don't manage my own money, by the way. I have no interest in managing I work at a bank. I don't manage my own money. I have a trusted advisor here at CIBC who manages all my money. So I go to my advisor in December every year. I look at my income the year, I look at my expenses, I look at my budget, and I say, what's my biggest appreciated gain that I've had in the 17 years since I joined CIBC and started investing with this guy? And he'll just send it to me. I said, great, donate X amount in kind to the charity. I sign a form, scan it, it's done. 5 minutes.
Yeah,
and I say 26% capital gains tax.
If you are lucky enough to have big gains and in non-registered accounts, to your point earlier, and you want to make charity contributions, the way to look at this is it's by far the most tax efficient way to do it.
Absolutely.
And the savings are not insignificant.
They're huge.
I mean, yeah, they're huge. And so I think you've done a wonderful job. I mean that very seriously, getting this out there.
I'm very passionate. I'm involved with a number of very big charities. And our job, as a volunteer, of course, it's all volunteer work, my job is to help them with financial things. Sometimes I've been the treasurer and I've helped them with budgeting and stuff like that. But my real job is on the donor side. It says, bring me your donors, and let me talk to them. And I get put in front of very wealthy clients sometimes. And I try to explain to them, and I do seminars for them. And again, all for free. I just, I really want to spread the word about philanthropy because in the end, we all benefit, right? As a society. To the extent that, people are more charitable and they want to give money to charity, everyone benefits, right? If you have a more tax efficient scenario, that means you can afford to give more, right? And then
that's
society
the exact right way to look
as a
at
whole.
It. If it's more tax efficient, you can afford to give more. And again, I don't even like the word give. I've always felt that when you get involved with charities, you're investing. And you're investing into your community, you're investing into that cause. And frankly, it sounds corny, but the returns from those investments tend to be the best out there. And so I'm with you, and it's great you're so involved in that end of things. All right, we're going to move to one more tax item around the average Canadian, because that was more for the upper income. A lot of people working out of their home now, working remotely, fewer than were obviously 2 and 4 and 5 years ago. What can they do on a tax front to limit their taxes? What are they allowed to do legally?
Yeah, so you're allowed to deduct your work from home expenses. I've been doing it, since COVID. I never worked a day from home, a day in my life until March the 13th, 2020, which is the day that we were all sent home.
Right.
And so I'm still working from home more than 50% of the time, although that might change in the near future where we've got some construction going on in our downtown headquarters right now. But I do come in regularly for client meetings and podcasts and things like that. But at the end of the day, if you're working more than half the time from home and your employer approves that, you can write off a portion of your home office expenses, right? That could be utilities, a whole bunch of things. So there's a form to do that. You need your employer approval. But ultimately, this could save you substantial money. But be careful, and because I've been audited on this myself a couple of times, right? They want to know, how much space are you using? Is this a dedicated space, or is it the kitchen table where you presumably also eat dinner, and therefore you got a prorate number of hours that you're really using it for work? But the best is if you've got a dedicated room, like I got a spare bedroom that I'm using full time for my office, so that any expense associated with that square. But in my case, 6.5%. Like when I divide up the home and take that bedroom and I add up the basement, 6.5%. So, if you're writing off 30% or 40%, you're gonna be audited, right?
Yeah, for sure. That's a red flag for the
You
CRA.
can't write off your mortgage, right? Like, so,
No.
I mean, for most people, if you're a homeowner, you're talking about utilities for the most part, and, maybe you'll save a few $1,000 at the end of the day. Where I've seen it really come in is for renters. Like renters who are paying thousands of dollars a month of rent, you can deduct 5-10% of that, and that's material.
It adds up. No, that adds up for sure. Yeah. What about your property taxes, insurance? They're all allowed to be included in the 6%?
It depends. Yeah, it depends. Most people cannot. I think if you go to the rules, I think you have to be a commissioned salesperson that you have to get compensated on commissions to be able to write off the property taxes. And you have to check that. But the rules are very, very specific on both the property taxes and on the insurance.
The principal residence exemption, of course, has been in the news a tremendous amount in the last couple of years. Rumors that the governments have been looking at ways to maybe tax the equity buildup, et cetera, as we're so desperate for funds. One of the arguments I put forth is that it would be impossible to do in a fair fashion because people haven't kept receipts for all of the renovations they've done over the years. So you've got people bought a house for X, now it's worth 3X, but some of that growth is not just market forces, it's the fact they've invested a lot of money in the house. Do you agree that we'd almost have to do it going forward and not on retroactive growth?
Yeah, look, I agree with you, but there's a number of ways. Like I've thought about this a lot over the last decade or so. I mean, Canada is very unique. We have an unlimited principal residence exemption, very different than the U.S. For example, in the U.S., I think it's $250 U.S. per person, $500 U.S. per couple, something like that, right? But in Canada, it's unlimited, right? So the average person, maybe they have $400,000 or $500,000 of growth. Good for them. It's a retirement fund, right? But there are people in Toronto and Vancouver and Victoria that have $2 million or $3 million of growth, which is, of course, tax-free. So, the government could look at this and say, well, wait a minute, is this really appropriate? So I agree with you. They can't go back retroactively and say, all of a sudden, as of tomorrow, you sell your house and we're going to tax the entire gain based on the cost. Because you're right, from a practical perspective, no one keeps the cost of their house and the renovations because you don't have to, right?
Right.
Unless you have two homes, one's a cottage, right? And there's reasons to do that, right? But I think what they could do, and I'm not suggesting this, right? Because it's not, not necessarily the right policy. But what they could do ultimately is they could say, okay, going forward, we're going to start to prorate. So take your value, whatever your value of your house is now, and that's another story. Do we get valuations or, whatever? Right. Maybe they use the assessed value on the land transfer, on the property tax schedule, even though that might be off. At least it's a starting point.
Something.
And what they say is, okay, well, if you sell it this year, there's no capital gains tax on that home. If you sell it next year, you'll have 1/2 years since we introduced it. So half of that gain post the valuation will be taxable. If you sell it in 2 years' time, it's 2 out of 3 years. If you sell it in 3 years' time, it's 3 out of 4 years. Or they could go back to the original ownership. And there's all kinds of ways they could do it. They could give everyone a $1 million exemption, right?
Yes.
But you're right. It's complicated. People would not be happy. And certainly I would agree with you. I think most Canadians are relying, not everyone, but most Canadians are relying on the tax-free nature of their principal residence to fund their retirement. Because not everyone stays in their home till the end. Certainly the last few years, depending on health issues, you've seen this, healthcare issues, and whether it's a retirement residence, a nursing home, some kind of assisted living, things like that. And mobility. I mean, you may not be able to stay in your home if there's stairs, things like that. It's a challenge. You got to sell it. So people are counting on that. It would be unfair, obviously, in my view, to retroactively tax that. I know it certainly wouldn't be popular politically, but
No.
ignoring the politics for a moment, I don't think it'll happen. I think they will at some point curb it. Although what's interesting is, I don't know if you saw, in the last month, the U.S. is actually moving the other way. There's actually a bill in the U.S. to actually introduce an unlimited principal residence exemption, right? So we'll see. Maybe they're sort of looking at Canada. I don't know if they're looking at Canada specifically, but they're sort of looking at that philosophy and say, hey, maybe the U.S. moves to a tax-free gain, and then maybe there's less pressure here in Canada. So
the quite wealthy seem to be getting a lot of influence on U.S. tax policy. There's no question, and I think that you may see that come into play. Okay, so we move on to estate planning.
Sure.
I'm going to give you a couple opinions. You tell me whether you think I'm right. I don't like joint powers of attorney for personal care. I think in theory they look great because you're splitting the duty. I think the problem is they can be gridlock and they often disagree. The process slows down. Some of those decisions have to be made carefully. Your thoughts?
Yeah, it's a very, very difficult discussion. I think that if you're going to have anyone other than, most people will put the spouse, and if there's no spouse, they'll put their kids, and most people seem to put all their kids, right? Because they don't want to
offend one.
Trust one of the kids, offend. But the best thing you can do, where I've seen this work the best, to be honest, and again, I'm not a lawyer, right? But where I've seen this work the best is if you can have an open and honest discussion with the kids, assuming that, everyone's still talking to each other, which is not always the case, right?
Not absolutely.
I've seen families that don't talk, right? They actually don't talk to one of the kids, or two kids don't talk to each other, right? But if you are fortunate in a situation where everyone's still talking to each other, and you can have that family meeting, at the holidays or in the summer or whatever. It sounds cliche, but it actually works. If you can sort of sit around the table as mature adults and say, listen, so-and-so is, because of their family situation or because of their wealth situation or because of where they live, it makes sense, I think, for me to name them as my, but I want to make sure that you guys are not offended.
Yeah, I like that.
If everyone signs off on it, that's the way to do it, I think. Better to have this discussion now than later on when they're fighting over, because we've seen situations where, the kids really disagree on, the type of care, and not in terms of like dramatic stuff like in the movies, like pull the plug or unnecessary heroic means. That's rare, right? I'm talking about like, do you live at home? Do you live in a hospital? Like who makes these medical decisions? Sure. How many hours a day care do you get? Do you have personal support workers overnight? Well, you know what? You're going to draw down the inheritance. So there's a conflict there, right? Because you got two kids, they're counting on receiving, $400,000 from the estate. And all of a sudden, one of the kids says, I don't need the estate. Let my parents spend the money on, personal support workers, which can be $120,000 a year.
It's crazy.
Money. And the other kid says, I don't think they need that much help. And then you get a real conflict. So it is a complex situation, but I think
we're going through that right now. We have, my father needs somebody overnight, and both my sister and I are saying, go ahead and spend down the inheritance. Do not move in with us.
Yeah.
Okay. This trade-off is a very good one. And my dad just laughs. And so it goes from there. But I'll tell you an interesting example of where that kind of conversation can be challenging. I did a video a while ago and I talked about how cottages tend to be the single most difficult thing to handle for families in the estate plan. Oh, it's crazy. And of course, one person has the money to improve the cottage. One person doesn't want to spend, just goes on. So I said in the video, it may be best to sell the cottage. If you're not going to do that though, you at least want to have the family conversation and talk about it to avoid these fights. 2 weeks later, one of my friends gets in touch with me and says, Dave, you idiot. I had that family conversation and now they're fighting anyway, but I'm still alive to see it. I would have preferred if they fought after I was dead and I missed the whole thing and I couldn't argue it. It was a fairly good point. Cottages are a hot spot on the estate planning front.
Yeah, where we have the cottage conversation. I've written articles on, the piece that I wrote on this is called What's Up, Doc? D-O-C-K. You can Google that. What's Up, Doc? Golombek, CIBC. And I wrote all about the tax issues, the estate planning issues with the cottage. But, what I often suggest, and this is non-financial, is ask the kids if they actually want it.
Right.
Because, if the kid lives in Vancouver and your cottage is in Muskoka, they might want it sentimentally, but they're never going to use it. Like maybe they'll use it for a few weeks, right? But at the end of the day, ask the kids, do you actually want it? And if you don't want it, great, you won't get it. And then we'll equalize the estate through, a principal residence or through other assets or maybe with a life insurance policy, which is very, very powerful.
Yeah, no, I agree with all of that. I talked to way back when in the Wealthy Barber about the importance of putting a net worth statement with a lot of details with your will to help the executor. I think, again, to give you credit, you've been one of the best people out there for pushing that and making this job, very difficult task, as easy as possible on the executor. Don't you think it's more important now than ever? I mean, estates have gotten so much more complicated. People have multiple accounts, private business interests, foreign real estate, but also passwords. A lot of times now, people don't even know how to get into the accounts because they don't have all the information. So is that something you push pretty aggressively at the client base there?
It is. So when I do my 10 steps to estate planning presentation, I've been doing for 25 years. It's almost exactly the same, right?
Right.
That I've been doing for 25 years. One of those steps is, a snapshot of your financial position where you list all your assets. And again, I don't want people listing every GIC and stock
Right.
and bond they have. That's not what I'm talking about. I'm talking about I have an account at CIBC. Yes. This is the account number, and this is the fair market value as of whatever particular date. Just sort of very high level, right? I don't need to know the value of your clothing. You're never going to get any money from your clothing. You're just not going to be able to sell it.
Are you saying that to me personally, or are you saying that to people in general?
Because maybe that shirt you could get.
Yeah, this shirt's pretty sharp.
That's a nice shirt. But I'm saying, generally speaking, don't bother with your personal effects, right? Maybe some salvage company you'll get 5 cents on the dollar. That's not what I'm talking about. I'm talking about the major financial assets, liabilities. I sort of joke sometimes that, even those liabilities that, sort of are off book. So maybe a brother loaned you, $50,000 years ago when you were in trouble. And you might think, oh, he's going to be so upset when I die that he'll simply forgive the loan. And of course, what happens is they come knocking at the executor's door the day after you die, and they say, hey, before you give the money to the kids, I want my $50,000 back. And all of a sudden, this liability emerges out of the woodwork, right? So I tell people, list all your assets, list your liabilities, including these, sort of off-the-book liabilities, and look at your net worth and have that statement, put it in a safe place, which, by the way, is not your safety deposit box. Because no one will find it there because they don't even know you have a safety deposit box.
Absolutely.
Because on your list, you're going to put, I have a safety deposit box and the location of it, right? So put a copy at home in a safe place, make a photocopy, and then tell your spouse or partner, your adult children, your executor where it is. Like I know my parents told me years ago, they've got a certain location in their condo. It's in this location. I know exactly where it is.
Now, you are such a trustworthy person, such an intelligent person. You must be asked to be an executor quite frequently. What are your thoughts on taking on that very big burden?
Never.
You sound like Dave Chilton. I did a video saying I don't help it. No,
I'll never
do it.
You know what? I would do it maybe. I think my parents are each other's executor. I think I'm a backup. That's it.
Yeah, I get it. No, I get it. It's so much work, and you and I are both
it's a liability.
Busy.
You have
it's
a liability
now.
Liability.
You can be sued, but also the family friction that comes with it. I mean, it's just a thankless job. Now, if it's a very straightforward estate, some people are going to argue with me and say it's not that bad. Even then, I'm cautious. But on these new complex estates with blended families, I mentioned foreign real estate, holdcos, all these things we're seeing more and more frequently. I want nothing to do with it.
I was speaking with someone recently. It was a lawyer who was acting as an executive for a couple of states. The stuff that she has to deal with, you wouldn't even believe it. Like this is a high-priced lawyer in downtown Toronto, and she's spending hours on the phone making phone calls to get insurance for the gas wood stove located. Like this is the stuff the executor has to deal with. So someone dies, and they've got to make sure that the property is secure. Like it is crazy.
Absolutely with you. By the way, to get to all our listeners, you've got to have a contingent executor. Over and over again, we're seeing now that somebody names an executor, doesn't put a contingent, the executor moves on with their life, dies, whatever, refuses to do it, and all of a sudden you're in trouble again. So do you always advocate for that too? And what do you think of corporate executors?
Yeah, look, I think you absolutely want to have a replacement or an alternate executor, right? And I think, there is a role. Look, I'm unbiased. I work at CIBC. We have a CIBC trust company.
Sure.
It does a great job. It's been around for over 100 years. Again, we don't take small estates, right? Like it's not worth it. It's not cost effective for us or for you, right? But for a more complex estate, a couple $1 million or more, if you don't have family members in the country or you don't have family members that get along, or you have a more complex estate with either a business or a bunch of real estate or some rental properties, sometimes a corporate executor is the easiest way to go. They have experience. They don't get emotional. They've done this 1,000 times. They can liquidate they're experts in property management. They know how to get insurance. They know how to, do all this stuff in terms of selling the, assets in the estate. Like,
for sure.
they're real experts. And look, they don't even have to be the sole executor. Sometime a lot of the trust companies will act as agent for the executor.
That's right.
Where you've got a family member that's actually making the sentiment. You get this picture and you get this silverware and things like that. But you have the trust company that's actually doing the physical administration. So they're handling paying the bills and opening the estate accounts and managing the money before it's distributed. And that's a lot cheaper, right? So
Absolutely.
Agent for executor, people should look at it. And if you're unsure, just speak to your local banker and say, look, can I do a free consultation with your estate people? Well, I want to talk to your trust company. I want a quote. Here's my situation. What do you think? What's it going to cost? And in many cases, I think that having a corporate executor, certainly for, more wealthier clients that just don't have, someone that really has the time. Maybe they've got the kids have got young grandkids. They just don't have the time or expertise, or they really can't be bothered. A corporate executor can be a great option.
Yeah, I think that's a good option for a lot of people, but I'm going to put you out there as the number one option. I think people should contact you personally.
Do not.
To be their executor.
Do not call. Cases. Do not call.
You mentioned one of my favorite subjects in estate planning when the executor says, you're going to take this and you're going to take that. Over my career, I've seen more arguments result from how those types of personal items that aren't necessarily very valuable but have great sentimental value, how they are distributed. I mean, I've gone public many times now saying you've got to do that ahead of time almost, and do it through a lottery system or gamify it in some way.
I've seen some very smart. I've worked with a bunch of estate lawyers. They're very good at this, and they've got a lot of experience, right? And that's why it's a good idea to get advice in advance. And I've seen some very interesting scenarios where the estate lawyer will go to the home with the beneficiaries, and ideally before death, but it doesn't have to be when the person dies, and everyone gets colored stickers. Have you seen this, David?
That's right, absolutely. That's what we did. The same thing.
Yeah, you red, blue, and they take turns. They flip a coin or a 3-sided coin or whoever goes first, right? And then they go in order, and they say you put your sticker on anything you want, and then you get choice, and you get choice, and they just keep going until everyone's chosen everything they want, and the rest of it they donate to charity.
The best one I saw, because it was so much fun, was everybody got 50 bidding points. And then the 4 or 5 people got to bid on the items, and you could spend 45 of your 50 on one item if you really liked it. I thought that was really cool too. But kidding aside about these, you need to do one of these things, because I'm being sincere when I say it may be the biggest cause of family friction are those little things that, again, have sentimental value to the kids, the grandkids, and everybody else. Talking this through ahead of time makes sense.
Some people are just also not rational. Again, I hear stories all the time from lawyers, and we deal with this estate planning stuff all the time. One recent story I recently heard was that someone had passed away, and one of the relatives was very, very fond of these, concrete planters that were up at the cottage, and these weigh like hundreds of pounds. And the advice was, we'll just give them away, or no, they absolutely objected, and they insisted that it be shipped to them in the U.S. And it was going to cost thousands and thousands of dollars to ship. I said, just go to Home Depot or no matter where, it'll be way cheap, but it's emotional. It's just emotional, and they could not convince the client, who has actually hired a mover to come up and bring these concrete planters. It's emotional.
It is. My sister and I are like that. We're very emotional, but we're fighting over who has to take my dad's cardigan sweater collection. We each want the other person to grab it for sure. We don't want to have anything to do with it when he eventually passes.
What there has to be what they call a sinking fund, which you often see with the cottage, where
Absolutely.
If you take the sweaters, you also get $1,000 you could pay for storage in a cold storage unit. So that it goes with it, right? It's just like with a cottage, where someone takes the cottage, but they also leave them a pool of cash to be able to pay for the annual maintenance, which is actually a great strategy.
It is a good strategy. My dad, by the way, thinks all this is silly because he believes he's going to outlive us and everybody else. His plan is to never die. In fact, my poor sister is his power of attorney for personal care. And he said, I only have one instruction for you. Never let me die. So she has immense pressure on her. I'm just doing the finance stuff. That's actually
there's a lot of talk about this longevity stuff. I just read an article just over the weekend in this week's New Yorker magazine, where there's this whole movement in the U.S. of these people that are, actually doing this research and doing all this stuff with biometrics about, could you actually mathematically live forever? and maybe not forever, but for 700 years. And it's actually fascinating the amount of, and mostly it's billionaires that, can afford to do this kind of stuff. But, it's just a fascinating discussion among the science and the pseudoscience that's out there. But if you want a good read, take a look at it.
I'll check it out. I love that kind of stuff. I don't think the actuaries have factored that into our pension analysis, so we could be in trouble. Okay, I'm going to let you go soon, but just two more things.
No.
Seeing a tremendous amount of gifting now, where you've got parents and grandparents helping kids out to buy their homes with this expensive marketplace. But it's not just that. It's people realizing that I've got enough, and I'd rather see the kids and grandkids enjoy the money now. They can do more things with it. They can max the FHSAs. They can pay down the non-deductible debt, or they can even do something frivolous, but I get to see them do that. And I get to see them enjoy it. Are you seeing a lot more of that in your practice?
Tons of it. In fact, we're big fans of this. I wrote a report about maybe 7 or 8 years ago that we just updated recently. And you know what it's called? It's called Give a Little Bit, which of course is reference to the Supertramp song, right? One of my favorite bands from the 70s. But, give a little bit. I mean, if you can afford to do so, and this is where it's important to work with a financial advisor, have a financial plan, a retirement plan to make sure that you don't need the money. Because, as we often say, the biggest problem with a gift that it's very hard to get it back later on.
You can't,
You can't get it back, right? So if you can afford to give, I would agree with you. So whether it's helping the kids, finance a home, help them with a wedding reception, help them pay off debt, student debt, the CRA debt in some cases, right?
For sure.
These are all great uses of money. You get to see them enjoy the money. Look, I say to clients, if you're going to give them the money anyway, at the end of the day, and this is never money you're never going to spend in your lifetime, why not give it to them in advance?
Absolutely.
A, you can see them enjoy the money, right? But B, maybe they don't need a mortgage. And now all of a sudden, instead of paying, interest to a third party like a bank, no offense, we want your interest, but at the end of the day, why not just keep it in the family? So you're saving an external cost, and there's more ultimate net worth for the entire family. So look, I'm a big fan of gifting. There are ways to protect a gift if you're worried about a marriage breakdown by getting a mortgage. There's ways, go to a lawyer, get the right advice, marriage contracts, prenuptial agreements. There's all kinds of ways to do it if the gift is significant. But again, there's also different philosophies on this. When I talk to clients about you're going to make a major gift, you're going to give them, $100,000, $500,000 to buy a home. And some clients are worried, what if they get divorced? I lose half the money. Yes. Other friends like, you know what? They get divorced. Well, they're still the parent of my grandkid.
Absolutely. That's what I say.
Half the money, and so they don't care. So you got to have these conversations, but there are ways to protect the money. But I'm a big fan of gifting. And what people don't realize, unlike the U.S., right, is we don't have a gift tax.
That's
right. You can give as much money to your kids whenever you want. It's not even reported on a tax return. So in other words, you give your kid $1 million cash tomorrow, that's it. They don't report it. It's like a tax-free gift in Canada. Now, if you give them $1 million of Apple shares,
they've got the deemed disposition.
Deemed disposition, capital gains tax. But if you're giving cash, just like money in the bank, or you've liquidated something already, you've got cash, that is a non-reportable transaction. And you just give it directly to the kids. There's no tax on it. They can take that money and do whatever they want with it.
You know what? I really wish you hadn't brought that up because my kids listen to this podcast.
Uh-oh.
And I have told them for decades there's a huge gift tax in Canada. And so they're now going to discover I've been lying. Now, we do have the true reversal again. I hate to pick on my dad, but my dad will say to me, you've been lucky to do well. What about gifting me some money now? And helping me. The guy's like 115 years old, but whatever. Okay, last thing is I put a video out recently about probate.
Yeah.
And my argument was, it's amazing how few Canadians know what it is.
Yeah.
Like when you walk on the street and ask people, they don't know what probate is.
Yep.
But beyond that, I think the governments, the provincial governments would be doing themselves a favor to have low to no probate fees or a very low flat fee. They'd probably bring more money in because they wouldn't have all these people working so hard to avoid probate.
Yeah, no, I agree with you. Look, probate is a valuable process, and it's very important to protect the executor.
Agreed.
And at the end of the day, the problem is that the fee that many governments, not all, some provinces have a flat
some are
fee,
great
right?
fare.
And they're nominal. They're $400 or whatever, right? But provinces like Ontario, Nova Scotia, BC, where you're looking at 1.5% on average probate, right? For what? For nothing, for validating a will. In other words, it's a tax. And in fact, they've renamed it in Ontario. It's not even called probate, right? It's called Estate Administration Tax. The acronym, we love it, EAT, right? So they eat your money. So Estate Administration Tax is the name of probate in Ontario. They take 1.5% of the value. They do the same amount of work, whether you got $1 million of cash or or you got $50,000 of cash. Of course, the first 50,000 is lower, but anything above that, 1.5%. So there's all kinds of schemes. Some are better than others about trying to avoid probate, using joint accounts, naming beneficiaries on RRSPs and RIFs and TFSAs and life insurance, to much more sophisticated strategies like a multiple will strategy, which doesn't work in every province. Right. It works in Ontario, where you have one will for your assets and one will for your non-provatable, like your private company shares. And then you get into like bare trust corporations, and it gets kind of complicated. But look, I agree with you. I think at the end of the day, this is a revenue raise from the government. It would be great if people actually embraced probate and people wanted probate, because it's a way of protecting the executor. Look, the example I give in seminars, people get so angry with probate. I said, you should be happy about probate. You should be angry about the fee associated with it. Because at the end of the day,
he said the exact same thing.
Someone comes into us and they shows us the will. And they said they got two kids, kid A and kid B. I am kid A. Here is my passport. Here is my ID. Here is the signed, sealed will of my dad. Comes into CIBC. We say, great. We verify you. We've known you for 30 years. And we pay out to kid A. A week later, kid B walks in with a will from the dad and said, look, I am the sole beneficiary of dad's estate. And we say, that's impossible, because we have a copy of it. We kept a photocopy. And we show him the will. He goes, oh, what's the date on that will? Because my dad actually changed the will a month later because he got into a fight with kid A. And actually, I am the sole beneficiary of kid B. So CIBC has now paid the wrong person.
Right.
We are liable because we relied on the will without getting a probate will copy from the court. So it protects the executor, protects someone paying out under the will. Probate is a good thing. The fee is a bad thing. And that's why there are all kinds of planning out there. But I would just end on this probate discussion is that I am not a big fan of joint ownership for anything other than a spouse or partner.
Okay, so I am so glad you brought that up, because I think that people are screwing this up big time.
Yeah, they are.
So you've got one spouse is deceased, and the other one obviously still alive, has a big pent-up capital gain on something. They want to avoid probate, so they just stick somebody's name on there, one of the kids. But they still have to pay tax somehow, some way on that. And they don't recognize that. They think it's just going right over to that person, but the tax liability is still there.
It's still there. I mean, most cases, they'll argue that at the time they added it was for estate planning purposes, so that's not a deemed disposition, although
that's right.
Ray might argue otherwise. But on death, they haven't really changed the beneficial ownership, which means on death, there's a disposition of the account.
Absolutely.
You still have to pay the tax on that. Where I really see big problems, I'm sure you've seen this as well, is where you name, multiple kids on there, or you don't name all the kids on there. And, what was the intention? Was it joint? Was it meant to really, go to all the kids equally, or was it really just done for convenience purposes? It is a mess. I've written many articles on the dangers of joint account. The joint account has actually gone to the Supreme Court of Canada on at least a couple of occasions, because people could not agree what was mom or dad's intention when they made an account joint. So again, my message would be, you want to do a joint account with your spouse or with your partner, no problem. Tax-free transfer, tax not free on death, no problem, okay? But if you're starting to do a joint account with your kids, be very careful. There are legal issues and there are control issues. I mean, the final example.
So agree.
We had someone in Vancouver, the British Properties, a client maybe 15 years ago. There was a client that was in their 90s, and she added her son as the joint owner of her real estate. About a year later, she wasn't feeling great. She wanted to sell her home. The son said, no, I don't think it's time. The market isn't right. But because the son was joint on the home, the real estate agent refused to take the listing because they didn't get the permission of the son, who was a joint legal owner on the home. So the mother couldn't sell her own home because the son was named as joint owner on the home and refused to sell because he didn't agree with the market timing. Imagine that, right?
I'm going to give you another compliment as we wrap up here. I think where you're unique and why you're so strong at this is you have the educational background. Obviously, you're very bright. You've studied all this, but you have a lot of frontline experience.
Yeah.
And you can see in your answers that you're weaving in psychology, human nature, what really happens on those front lines when you give a lot of this advice. Yeah. I think occasionally we have a lot of financial experts, and they are very knowledgeable, but they haven't sat across the dining room table from the people. They haven't sat across from all the advisors and seen the real life scenarios because they don't tend to play out the way you think they're going to. And I think that's one of the reasons you and I tend to agree on everything. Is because we've both seen these things play out and all the things that can go wrong. And when it comes to estate planning, sadly, if it can go wrong,
Yeah.
It usually does.
Yeah, and again, I'm in a fortunate position. I've been in CIBC for 17 years. I've been in this industry for over 30 years, and I've seen almost everything. And the nice thing is I sit here sort of at head office, and I really run the tax and estate group for all of Canada on the client side. And I see the most interesting, complicated cases because they eventually, ultimately will funnel up to me. Not for practical issues on how to deal with an estate. We have a whole department that deals with that. But on the planning side, on the advice side, because I hear from the advisors. We have thousands of advisors who have millions of clients, and I hear all the good stuff, right? So I hear all the juicy stories. I'm out there speaking 80 to 100 times a year. So I actually meet with real people and actually meet with real clients. Like, every week I have 2 or 3 actual meetings.
No,
right?
You can see it. Again, you can see it come through with the stories.
And we see all kinds of stuff. And the good thing is that there's common themes, and we try to learn from those themes and provide feedback. And some families give us ideas that we share with other families. And that's why I really think the important message is advice. People need advice. And I think there's a lot of great advice out there. If you don't have a great advisor, you should get one, because there are some great advisors out there, whether it's lawyers, whether it's accountants, whether it's a financial planner. But people don't have to do this on their own, right? It can be very intimidating.
You didn't say whether it's a barber. You were supposed to throw that in too.
That's true. Absolutely.
Listen, I really enjoyed this. I mean, great seeing you again. Your knowledge blows me away. You're very, very good at this, and you're a great communicator.
Yeah, and yourself as well. It's mutual admiration for sure. And I was thrilled when I got the invitation. And again, I until recently, I taught an MBA class in personal finance at the Schulich School of Business at York University in Toronto for 17 years. I taught an MBA course, 13 weeks a year. For 17 years. I just stopped a few years ago during COVID with the distant learning, and I didn't want to go back anyway. But I always said at the beginning of my class, when I do my chapter on budgeting and goal setting, I show them a copy. I actually tried to find it this morning. It's somewhere in my house. The original Wealthy Barber from the original tour when we met in a Halifax casino hotel by the water that keeps changing names. It was a Sheraton at the time.
That's right.
You were speaking and I was speaking, and I think it was a co-sponsored event with my previous firm. And I just tell people, look, just follow David's advice. The Wealthy Barber, save 10%. If you can save 10%, that you're going to be just fine. Now they ask me, is it gross or net? Gross. Save 10% of your gross income, you're going to be fine.
No, you said all that very well, and thank you. And it's amazing you and I don't look any differently than we did all those years ago.
You look exactly the same. You have a better show.
I wish. Anyway, good seeing you again, and come back anytime.
Absolutely. Thanks again for having me.
Thanks, Jamie.
Great.